How's everyone doing today? Welcome back. Today we're doing lesson 20, which is indicators. A lot of folks have been waiting for this one. A lot of folks are going to enjoy this one. I think it's going to be a really good lesson in my opinion. Today we're going to cover the importance of indicators, but also to put in context with my cat being on the way today, how indicators are not as important as price action. That's key. Price action always comes before indicators. You may think that you can scan with only indicators. That's fine. That's your choice. Buy off only indicators. That's fine if it's your choice. My edge, what I believe in, does not look that way. Price action always comes first. Indicators only reinforce or deter me from my positions. If I really like the entry based off of value or a crossover, whatever it may be, which we'll discuss, indicators should add to that and that support or take away and deter me. That's it. Indicators are going to show you 4 things and only 4 things that support or take away from your position. Trend, momentum, volume, and volatility. That's it. Those are what they're going to show you, those 4 things. Anything besides that, you're looking at it the wrong way. For trend, I use EMA lines. Now you can use SMA lines or MA lines or none, but I think that EMA lines are some of the best ones you can use, or SMA lines. I use those in particular, and I'll show you how I use them for every single trade that I use. Now RSI and Stochastic act very similarly, but I'm going to use them in different ways to show you 2 different things that they can do. They're great for momentum, and they show you some really good stuff. For volume, I obviously use traditional volume on my equities, but also I've gone over volume profile. I won't cover that today, but again, that's what I use for volume. And then lastly, for our look at volatility, I'm going to use the Vortex indicator. The Vortex is super cool. It was actually made in 2011. I've been using it for a few years now, but I've always researched it since it came out because I was really interested in it. It's a great indicator to use. I also use the VIX, which is a equity itself, and it's a really nice ETF that you can watch. That's also good for volatility. So the first one we talked about is EMA lines. Now again, you can use MA lines, SMA lines, or EMA lines. They're all fine. You'll find that SMA lines are more conservative and slow moving. EMA lines are much more aggressive. I use EMA lines. The reason is, I myself am very conservative in how I set up a stock. I want it to be perfect. I need to have all the things lining up well. SMA lines are so conservative, more times than not, they're not going to be useful in an already conservative setup. So I use them very rarely, but I use my EMA lines much more often because they're so much more aggressive and they move much more volatile. It lines up better with what I'm doing. So if you find that you yourself are a much more aggressive trader in your setups, maybe SMA lines is a good way to even yourself out and to be more true to yourself and be a little bit more conservative. You don't want to be overly aggressive or euphoric or overly conservative and fearful. You want to make sure you're balanced, and so EMA lines are good for conservative traders. SMA lines are usually pretty good for aggressive traders to begin with. So how I use them, I'll show you. I use 3, the 10, 50, and 200, and I'll show you. So this is WBA with no indicators on. Let's turn on our EMA lines. So what you're going to do, you want to go to studies right here, edit studies. Now you can always make a set like I have for some of these things, but you want to go ahead and put an EXPO, exponential moving averages, 1, 2, 3. So that you don't want to mess with the 0 no part, but where it says 9, I'm going to put 10. Great. Where it says 9 again, I'm going to put 50. For my 50 line, I use purple. There's no reason. I just like to have different colors, so blue, purple, and then 200 because it's a big serious line. I'm going to use red. Looks good to me. You could also do drawing as, dots or whatever you want to do, numerical Boolean. You can do different styles. You can make like the 200 wider if you want to make it more serious, whatever it may be. It's really up to you. I keep it all just 1, 1, and 1. Looks good to me. So what we're looking for with the EMA lines are a few things. The first thing we're going to use is the 10 EMA line. What the 10 EMA line is used for is short-term reversal confirmation. What do I mean? On the 180-day 4-hour chart, we're already only seeing 2 to 3 candles a trading period depending on what year it is, because sometimes they close at 10:30 and then 1:30 and then 5:30. Other times they change at like 12, 4, and 8. It just depends on the year. Those will change. But on this time frame, the 180-day 4-hour, the 10 EMA line is great for a short-term reversal confirmation. If you see your price go from below the 10 to above the 10, that's a great sign. At least in the short term, you have a reversal change. The same thing can be said for the 50 and the 200, but they're more severe the higher the number. A crossover the 50 is more significant than a 10 crossover. A 200 crossover, when we go from price over the 200, is more important and more showing than a 50 or a 10. You can use the 50 and the 200 for different things though, and I'm going to show you this right now. The 200 is best for bounces. I'll show you. So let's say we have WBA, right? We can do all the price action we want to. You can come through, put your supports, put your resistances, all that kind of good stuff. For this, let's keep everything off. I was study. Let's go back to study. We'll put in the word expo. Go to moving average exponential. Put in 200 once again. I make it red so I stay consistent. Apply. You can see now with this price action, even over here too, with this price action, bounce, 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 bounce. You can see the 200 for WBA. This is the stock. It's a really great support area. So we have the knowledge now that we have a great support in 200 EMA line. On this time frame, with this stock, it respects the 200 mightily. What can we do now? So now that we know this, let's say we have this knowledge. We want to do all of our charting once again. We have our support here. That's great. We have an obvious trend line right about here. Right? That looks great to me. I mean, you can be a little bit less aggressive. You want to come from here and come up and say we have more room to run up. I wouldn't go with that. I think this is a great spot to come from. Right about here, where this gap is. Come from this gap, come up. We can see almost a perfect trend line as always. Looking great. Come through, make that a channel for now. Get 3 hits. 1, 2, 3, 4. Now we have an extra layer of convergence. The 200 EMA line is a support and shows value. So we know that it bounces off of, and when it breaks, we have value. You can go off of the price action alone and see we have value, but now that we're below the 200, which once again, on this time frame, when you're below it, value, 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 value. So you may want to enter the stock based on value because we're right below the 200 EMA line, which is a great sign of value and support. Now, with your price action convergence, you now have an extra layer of support and confidence in saying, hey, it's near support, it's near a trend line, and it's below the 200 EMA line. That's great. So this works fantastic for a lot of stocks. Some stocks will not follow 200 at all. They'll be too far away or too far below. It doesn't mean much. But again, just looking at it, so off the bat, we can see that it shows what? Trend. Remember, there's only 4 things it can show you. Trend, momentum, volume, volatility. That's it. We can obviously see that WBA's trend is up. So even if the 200 EMA line is not useful in a ticker, if it's pointing up, that's a great sign. With that being said, the 200 is great for support and to show value when applicable. The 50 is very similar, and I'll show you. So this is Funko FNKO. It's been on a tear recently. It's gone up almost 200%, 300% in a year right now. Let's see if we can find the trend right now. So let's go to studies, edit studies, exponential moving average. We're going to add 2. Again, let's make a 50 and a 200. The 10, again, is good for short-term movements. It's fine to use, but for these kinds of things, the 250 are mightily more important. Apply those, looking good. We can see on this time frame, the 200's been hit once, twice, and that's it. If the 200, the 50, the 10 don't have a lot of action, again, revert back to what they're used for. Trend direction. And so the 200 is not being used right now. It's not being hit at all. So again, we're going to go and see what trend it is. Up, sideways, or down. That's it. We can see the 200 right now is pointing up. So again, if you're going to use trend lines as your main determinant for which way it's going and for bounce plays and all that kind of stuff and supports, the 200 cannot be used. It's not being used at all. All you can see is that from here, it's going up. So again, our overall trend is up. Fairly obvious. The 50 EMA line is going to be your best line for some tickers to find bounces and support as well. So it really depends on the ticker. Sometimes the 50 is going to be the best for bounces. Sometimes it's not going to be relevant at all. Like the 200 right now is not relevant for Funko. But once again, it's to show you trend overall, but bounces can be used. Let's check it again. So FNKO, we can see plenty of times on this time frame, bounce, bounce, bouncing, bouncing, bouncing all the way through. It breaks down here, shows some more weakness, but once again, on this whole 5 to 6 month streak, anytime I got close to the 50, you could have bought in and made money. That's mightily important to know and to realize what stocks that you're watching. EMA lines are great for trends and they're great for bounces. What's going to be mightily important moving forward is how you can use them for crossovers and value. 9 out of 10 times when I enter a stock, it's because of one of those 2 things. Value or an EMA crossover. If I see an EMA value, like if it drops below the EMA to a point on the price action, that's a good buy-in and value based on what I see, I'm liable to buy in. And if the 50 200 or 10 EMA line or above it and they're close, and we cross over that, that once again is a sign to buy in. Without the EMA lines, this is not possible. It gives you a great lens into what value is and what a good crossover is. Let's look at some great examples of some crossovers. So this is COR Core. It was a great horizontal play. It took off on us. We called it over here on my Discord, which was really cool. It made a big move and now it's coming back down. A great example of a crossover and using the exponential lines is this one. Let's use the 10 for this example. So go to studies, edit studies, expo once again, moving average. We're gonna change this to 10 from 9. Keep the same color and we're gonna hit apply. You're gonna notice on this time frame with this particular ticker, it doesn't work for all of them. Each one is different, but for core, this is how it works with the 10 EMA line. We can see clearly when price breaks above or crosses over the 10, we have the biggest and best runs. Is it perfect? No. But we can see historically, let's zoom in. We break the 10, we have a nice 8% run. We get back below it, we die down. We get back above it, we have a nice 8.3% run once again. We get above it, right here, a nice 4% run. Right, you can scoot out a little bit more. 6%, a nice 16%, 18%. Here's a fake out. Still up 3, but a nice fake out. Again, crosses over, 5, crosses back over, 6, you get the point. This same exact logic can be applied to the 10, the 20, the 30, the 50, the 1000, whatever the EMA line is. When your price crosses over the EMA line, that's a great sign of value. One thing to note, we'll talk more about this when it comes to the how to enter a stock section of our whole entire class. But a rule of thumb that I have is let the candle on the time frame finish developing. Wicks are important, but not nearly as important as the body. 9 out of 10 times, folks who buy a breakout on a crossover buy in when it crosses above it, it wicks back down, and then it continues down. I like to wait for the first candle to solidify over the EMA line. Until that point, I'm on high alert if I have other reasons for price action to enter. Like let's say it's at the bottom of a channel, and the support's there and volume profile says buy in and volume looks good and it hasn't completely solidified yet, still going back and forth, I may buy in. But 9 out of 10 times I wait for the candle to get done working to buy in. This same logic of price being below a 10, 50 or 200 EMA line to crossing over it can be applied to any EMA line, SMA line. It's a very popular strategy. It works really well. What I want to show you next is a particular trick that I learned trading for a few times, and it's with triangles and EMA lines. One thing I find super interesting about swing trading on this time chart, the 180 day, this may be true for other timelines. I haven't really checked because again, I stick to the 180 day and maybe the 1 hour or 2 hour charts, is that when the EMA lines are in the middle and going sideways during a triangle or a horizontal wedge or a horizontal triangle, when the EMA lines are in the middle of that, that reinforces consolidation. What do I mean? Stocks can do 3 things, as I've said: ascend, descend, and consolidate. Most big ascensions and descensions come after consolidation. A wedge or a triangle is in fact consolidation, especially horizontal ones. I love to find perfectly set up and really close to perfectly set up horizontal triangles on this time frame. And if the EMA lines, the 15-200 in particular, are in the middle of the triangle, so it looks like this, that's the triangle, like this, and the EMA lines are towards the middle of it, kind of going horizontal into it, like this, that only reinforces my hunch that it's a triangle, and I'm going to show you. So this is AMPE. Again, I had the charting on because that's important. We can see clear, I'm going to say high or low, HL for high low, HLs, HL, 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 HL. Consistent higher lows and consistent LHs, lower highs, lower high, lower high, lower high, lower high. This is textbook consolidation. The bulls are pushing the price up, bears are pushing the price down. And so we see clear consolidation, that clear coiling. Click, 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 click. What happens after the click, click, click? Boom. Great saliva joke, right? 2005 song. So AMPE has clear consolidation, right? If you want to reinforce your hunch, studies, we're going to just go low studies, EMA lines. I have that set up. We can see what? As we get closer and closer to the end, where are they? These lines are directly in the middle of the triangle. See how sideways they're going? Even though we have action, these are going sideways. You see how this triangle? They're directly in the middle. EMA lines on this time frame are a great tool to help show consolidation. If the EMA lines are going sideways, consolidating horizontally, look for wedges and triangles forming. At worst, it shows you consolidation. What happens with this is fantastic because we see big moves happening, and AMP had one. This is a prime example of what can happen. We can see we move over a few clicks and we had a massive breakout of about 50%. It ran up 40%. It ran up hugely. It was great. Of course, this had a catalyst coming with it. It was really a prime move. It's a rarity. It happens as well. But again, the EMA lines helped show consolidation. We had a big move. It's a fantastic tool and hint to use. So the last thing to mention with EMA lines at this point is this. When the price is above the 200, the 50, or the 10, for me, those EMA lines, they will act as a support. Just like with horizontal supports and resistances, when price is below the 10, 50, and 200 EMA lines, these will act as resistances. So it's a double-edged sword. Something like AMPE that showed consolidation, that whole entire move over, every time we're towards the bottom of that triangle, those EMA lines that were above it are going to be resistances, and I'm going to show you. So this is NG. It's a nice Nova Gold Resources ticker. This is a really good looking downtrend, and again, you're like, well, really good looking. Yeah, it's very consistent. Barring all price action, which you should always add, let's check out the EMA lines. We can go back, throw on the 10, 50, and 200. We can see clearly that this downtrend was mightily important and reinforced by the EMA lines. It may be hard to see at first. You may be like, I don't see it. Let's go back and check it out. The main thing to look at is the 200. So during this whole entire time period, we can see a nice run up. It's coming down. It's coming down. It gaps over the 200. Okay. It comes back down. Now that we're down here, it comes up and does what? It hits the 200 and dies. It comes back up. It hits it and gaps up, and then it dies. Hits it again and dies. It comes all the way back down, taps it, dies, taps it, dies, comes up, taps it, dies, tap, tap, tap. We can see clearly with NG as an example, whenever the price was below the 200 EMA line, it acted as a resistance. The same happens with the 50 and the 10. It just depends on the ticker. But again, when the EMA lines are above you, yes, you have value. You have clear value if it's a setup. But also we have a clear added resistance. Just like with convergence with supports, there can be convergence with resistances. If the 200 EMA line is lined up perfectly with an old-fashioned horizontal resistance and a resistance trend line, that point breaking it is going to be almost impossible without a lot of power. Let's check out another. So this is surf. We've used it earlier in the lesson for riding up some stuff. Let's check it out on the downtrend over here. Again, studies, load studies, EMA lines. We can see clearly the 200 was a resistance, but more importantly, so was the 50. Come up, 200 was a resistance. Again, so was the 50. 50 was a resistance. It acted as support right here. Boom, resistance. Boom, resistance. Resistance, resistance, resistance. Got close. Resistance was a resistance. Now, when you get back over it, what happens? Support, 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 support. We can see surf always respects the 50. If you are below the 50 EMA line on surf, it's going to be a resistance. When you're above the 50 EMA line on surf, it will act as a support. So with the idea of convergence in your head, and with this being an added layer of support or resistance, when you're picking an entry for surf, if you're low and you have a good value based on price action, but the 50 is above you, it's going to be resistance moving forward. Make sure your price target on the short term is not above the 50, or at least near the 50. Long term, sure, but the short term price target needs to be close to and tied to that 50 EMA line that's above you. You could also go with this. If you're on a big run up and you start pulling back, you have a good 15-20% move up, you start coming back, but the 50 is right there, maybe hold until it hits the 50, because if the 50 is a great support, maybe it hits that and it keeps on going. So again, have EMA lines in the back of your head. Always have them turned on when you're holding or at least tracking a stock. They can be mightily important to show you the trend that you're working with. So that's basically it for EMA lines. Again, they're going to be used to only show you trend, but again, bounces and your entries based off value in a crossover can be mightily more clear when you use EMA lines correctly. We'll talk more about entries and exits later on, but again, just for now, just know that entering and exiting stock can be much easier and clearer and have a greater and better plan overall, with EMA lines being used the correct way for a trend and for bounces. Next, let's discuss momentum. Now, RSI, it's probably fairly easy to understand. I'm sure most of you guys who are beyond a week trading have heard of this, and you guys can probably go check it out on other videos. And again, please go follow and listen to them too. It's great. But for RSI, I have some great stuff to look at. Let's check it out. So this is GBIO, probably one of the easiest to read horizontal plays I've seen in a fat minute. Let's just do this. We're gonna add in some supports real quick. That's one. That's one. Real simple. Let's not get ahead of ourselves. Let's not get ahead of ourselves. Clearly, that's going to be our main channel right there. We have 5 supports and resistances. This looks great. Of course, we can get lower, but for action right now, we'll probably lower this just a little bit, right about there. Right. This looks really good. Let's just turn on the RSI. So RSI, or the relative strength index, is going to show you the strength of the momentum or the trend that we're in. So again, most folks like to buy low and then sell high. RSI is really good at showing you where buying low is, and again, it's just an indicator. Buying strictly off of the RSI is never a great idea, but again, if the price action says you have a value, the EMA lines that we've added say you have a value, volume profile says a value, now this says a value, more likely than not, you have value. Key term, more than likely. You can have a great value and it still goes down because, hey, there's always a better value possibly. If it's not at 0, it can get lower. So we have a clear chart here. I'm gonna make the chart a tiny bit smaller so you can see the RSI a little bit easier. What we're looking at, most folks are gonna consider under 30, or usually under 40 to 30, and then to 25. Anywhere from 40 to 25, usually under 30 is gonna be what's considered a good value based on the momentum and the relative strength. When it gets this low, you're dealing with a good value. And when you get above 70, you're dealing with an overbought or a commodity or equity that has too much momentum. It's too high, it's not going to last, it's basically overbought. So under 30 is considered oversold, over 70 is considered overbought. You'll see that there's many stocks that don't follow that rule, but for some it follows it to a T. It'll make life much easier. So let's do this. With GBIO, we want to buy low and sell high. So let's turn on this thing. It's called the price, it's called the time level tool. It's fantastic because it puts a line through all indicators in the time chart as well. Let's mark every time it was oversold. So we have oversold here. We'll put it right in the middle. Oversold there, there, middle there, and right in the middle, we're about there. So what are we looking at? What I want to see by doing this, which I do very often with my stocks by myself when I'm charting myself, do I have success from going from low to high when we have oversold stocks below 30? Let's check. Now, not every stock will follow this, but we can see GBIO. If we would have bought down here and held, we would have made money. If we bought here and held, you would have gotten an 8% move, but again, you would have long-term been burned. Same with here. You would have at least made, 10, 15%, so that's very encouraging, but again, I'll consider these both wins because it did go up. Here, would have made money, and here, it would have made money. No guarantees ever, but at least here, 5 out of 5 times it was below 30, we would have made money. That's a great sign. So we can currently see that works out very, very well. We can also take the same exact time chart here, right? So let's just take this line. We're gonna make it red now, really quick. So what we're gonna do, I wanna see every time it's overbought, do we lose money? Right here, right middle of here, and middle of here. So once again, we can just, with RSI, you go from oversold to overbought, you would have made a complete move, and then you would have lost money, right? From up here, you would have held overbought, would have come down and would have lost money. Overbought, you would have lost money, and overbought, you would have lost money. Even better, 5 out of 5 times on oversold, you would have made money. 4 out of 4 times on overbought, you would have lost money. RSI and GBIO is deadly accurate. Now again, I wouldn't solely buy off of a stock because of the RSI, but this in itself shows fantastic strength of momentum index. RSI in this time frame with this stock is almost a perfect setup. It's below 30, you buy, you hold to overbought, you make money. Easy peasy lemon squeezy. So this is a great way of showing us the temperature of the stock and how how good a deal is or how great a bargain is and how high up it is. Let's check some more. So here's ASR. We're gonna notice with the RSI off the bat, it never gets oversold. That's okay, it's not below 30. what I like to do is this. Take your time level and your price level tool, and let's do some charting on the RSI alone. Let's make some levels for the RSI. We can see right about here in this area, it's almost like a support and resistance for RSI, right? It comes down, bounces off of it, bounces. You can see right in here, it acts just like a stock would, right? We can come down here, add one more. This is probably a good area as well. And so is down here. What we're doing is that we're kind of making levels and supports for RSI in itself. Let's see if it correlates to the chart. So we can see we have great levels, almost like it's showing us risky entries, right? Entering here at this line is like, you know, it's red. It's a little bit higher risk. Entering here at this line is okay, right? It's not too bad. But entering here on the RSI, as we can see if we zoom in, is much more successful and much safer, right? Let's take our time level tool and let's kind of zoom out real quick. So once again, let's find every time it hits the green line. So from here, looks good. Let's make this green real quick so we can keep it nice and consistent. So we have there, there, there. And again, I'm just seeing whenever it hits the green line, not looking at the price action at all. And that's close enough, right? So every time it hits the green line, what do we see? Money, 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 a small move, a good move, and then a small move. Once again, on this time frame, 6 out of 6 times at the lowest RSI it hits, you would have made money. Let's check the yellow line. So let's check this yellow line out real quick. Again, we have here, we have here, here. We're going to go through and see every time it hits the yellow line and not the green line, right? Here, here, boom. So we can see clearly, make this green again, our lines. Again, with the yellow line, money, lost, money, lost, lost. So we can even see there 2 wins and about 3 or 4 losses. So the yellow line is not the best place to enter either. It's okay, but it's not great. Let's check that red line. So with the red line, every time it taps that here, here, and not the yellow one or the green one, just the red one, here, here. It looks like we're getting to right about there. We'll see what happens with that. So we can see on the red line taps, we have success once, twice, 3, 4 out of 4 times. So interesting enough, the red line itself does show some great value. Now again, I think more times than not, it's because we're on an overall uptrend. But with this being said, it's clear to you and it's clear to me when RSI gets to its lowest area. For this, it would be about 34, 35 on the pip level, which is what you call these are pips. So when you get close to about 34, 35 on the pips down here, it's the best place to enter, or a retest bounce around 48. So 48 or 34 are your best entries based on RSI. Again, it's not a perfect science, but again, layering out levels of support on the RSI that correlates to the price action is mightily important for success and accuracy. Let's check some more. This is CRL. Let's do that one more time. I'm just going to go with time level for this one. Every time we get below, let's just do this. Let's go below 40. That's probably a good level. So every time we get below 40, let's make a line. So below 40, below 40, 40. And there's going to be a bunch of these, and that's okay. Below 40, below 40. Just like that. And let's count out the success one more time. Fail, success, success. So that's 3 to 1, 4 to 1, 5 to 1, 6 to 1, 7 to 1, 8 to 1. 8 out of 9 times CRL would have been a great buy based off of RSI alone. Once again, we also had great price action. There's great supports and resistances, a great trend line we could have drawn, but based solely off of RSI, it did really well. Let's check one more. This is MCFT. Once again, we have barely any oversold. We have plenty of action that bounces off towards what I would consider probably 38 pips. It's a lot of bounces there. One more time. Every time it hits 38 pips, let's make a time level. Once, twice, 3, 4, 5, 6, 7, 8, 9. So let's go through these. Would have made money, great. Would have made money, great. 3, 4, 5, 6, and then 3 losses. So 6 to 3, you can see we have a clear downtrend. It doesn't work all the time, but again, let's check the price action. So we can see over here, we have a lot of RSI below 30, but once again, the clear determinant and changing factor is this. we have a clear support right about here. Every time the support, once, twice, 3, 4, 5 times got hit over here, it was successful. This is above our support area. So once again, until we have clear support or a clear area to buy in based on price action, there's no point of buying in. You have a clear support also down here. We're breaking that. So again, this would have been early buy-ins. This would have been okay. All right, but these two, again, based on price action alone, I would not have entered. So it really just comes down to me for price action first, and then the RSI hitting where you think is a good value. One more tip, you can set alerts with RSI. Yes, price action, you can set alerts while price crosses, but RSI works too. Let me show you real quick. So let's just say MCFT. Once again, I'm convinced every time it gets below 30 or below 40, I'm happy to enter. Here's what you're gonna do. You're gonna right click, go to create alert. You'll see all this and you're like, whoa, that's confusing. It's really not. What you're gonna do, and you can always, again, rewatch this video, you go to where it says price, mark, you're gonna study, edit study. One more time. All this doesn't matter. You're on MCFT, it's a stock, that's fine. Mark, you go to study, edit study. You're gonna have nothing here, that's totally fine. First thing, the most beginner mistake is this. They don't check the condition setup. I'm gonna show you. A lot of times you don't even see that this is right here. See this little drop down? You can see all it really has is a little bit of nothing there. What's important though is this says condition setup 4 hour. You have to choose the right time frame. 1 minute right here, 2 minute, whatever it may is. You can even do like, every 4 days. You can do a yearly chart, right? It has to be set correctly. 4 hour is what I use. So make sure your condition script is set to 4 hours. Most times you open this, it's set to 5 minutes. Not very useful. So again, 4 hour must be selected before you move on. If you do not change this to the 4 hour or the time frame you like, if you like to use like the 20-day 1 hour chart, make sure it is set to 1 hour then. So make sure that is hit correctly, including or excluding extended hours. I have extended hours turned on. I have the highlights turned off, but that is turned on for me. So what we're gonna do is I'll go to condition wizard, do add condition. So it's fairly simple. This is a study, right? RSI is a study. That's why you hit the studies to turn it on. So you go to study, click it. All these are turned on. You can do anything. You can do CCI crossovers. You can do momentum. You can do exponential line crossover. You can do like moving average, right? You can even do that if you really wanted to. Go to exponential moving average. You can do that. Crosses below. That's also fine too. So for RSI, it's study. RSI. Don't change anything. RSI is less than or equal to the value of 40. Boom. Because now when RSI crosses below 40, it's going to go off on this time frame. So every single time it crosses below 40, we'll have an alert. Save. When RSI is less than or equal to 40, it goes off. Looks great. Okay. When the study is true. Again, when the study chimes true, you'll get an alert. We hit create, and now we're good to go. To check your alert, go to Market Watch and Alerts. I have all these going off today because it's a red day. Ha ha ha. Let's go to context. We were just on MG. We can see for MCFT right there. You see it says MCFT 4 hour RSI is less than, and it's true. That's going to trigger in about 4 or 5 minutes. It takes about 5 minutes for it to get set up. That will trigger. I could probably show you in the episode when it goes off. So I find that alert extremely useful. Of course, you can set up ones for, EMA line crosses like the 50 cross, the 200, whatever it may be. I can show you that later if I really wanted to. That's fine. But the RSI one is extremely important if you like to use that for sure. It helps you from using your whole day watching it like, will it cross below the 30? It'll just tell you what it does. It's really nice. So the stochastic momentum indicator is the other one I use for momentum. It's a really great indicator. I use it for one different thing though. I use it for divergences. So a divergence is a fairly easy thing to understand. What a divergence is when you're measuring peak to peak or bottom to bottom. So again, when the price action, you get a higher high, a higher high, a higher high, or you have a lower high, lower high, lower high. You're gonna measure those two things, or a higher low, higher low, higher low, or lower low, lower low, lower low. You're gonna trace the peaks and the bottoms. What you're gonna do with the price action peak to peak or bottom to bottom is then compare it to the stochastic momentum indicator. If it shows something different, that's a divergence. It may sound complicated now, but I have plenty of good examples, about 6 of them. Let's go look at them while I explain it once again. So this is CX. It's a really beautiful uptrending stock. Once again, we could go through and do all the charting. You can see a very clear uptrend, all that kind of great stuff. Again, I trust you at this point. Let's just check stochastic momentum indicator. So go to studies, edit studies, come over here, STOCH, and it's going to be momentum index right there. Apply, it looks good. Off the bat, we can see it's very similar to RSI already. What we're looking at is -40 being oversold, 40 being overbought. Those numbers, no idea why I chose them. Again, I can go on the math for you, but again, -40 is oversold, over 40 is overbought. We'll see also there's many more bottoms than RSI. It's much more fidgety, so you can see plenty of times it goes from -40, where my cursor is, you would have actually made money. So off the bat, -40 on the stochastic, it's a bit of a lagging indicator. Again, it takes a day or two to show you, but many times on many charts, -40, again, I can just go through and show you, every single time it broke -40, off the bat, we can see you would have made probably fairly good money fairly quickly, right? Every single time on -40, it looked really good. It can be used for that like RSI, but stochastic has one more thing I want to check. Again, for a divergence, I'm checking bottom to bottom of the price action and then bottom to bottom of the stochastic. What I'm looking for is for them to not line up. Let me show you. So what I'm looking for is for them not to add up. We can see this whole area over here, a nice uptrend, right? This has come from over here and go over. We have clear higher lows, but on the stochastic from that same exact spot, we have almost a straight line, right? To be more accurate, let's just come from here and over. See, we have higher lows, higher lows, higher lows, but from here over, we actually have lower lows. So you see this divergence, higher lows getting higher and higher, and we have lower lows, lower lows, lower lows. That to me is a clear bullish divergence. You're gonna hear on YouTube and other places they say things like reverse or inverse or bullish divergence or reverse bullish divergence. The easiest way to describe divergences is this. When you're connecting bottom to bottom, it's always bullish. If the price action and the stochastic do not add up on the bottoms, it's like a triple top, but it's going like this, bullish divergence. You have 3 bottoms like this and 3 bottoms like this, bullish. It doesn't matter. If you're connecting bottom to bottom across the board, it's always going to be bullish. The opposite is for top to top. Anytime you connect top to top that don't add up, like the stochastic and the price action don't add up on the tops, always bearish 100% of the time. That's the easiest way to look at it. So once again, we can see even clearly, like even over here, go from here and over, right? Clear, nice trend line. Again, clearly nice lower lows. Again, I don't like cutting through stuff, but again, it's super clear, right? Let's check one more. RL, again, you can go -40 and make money all the time. Like, you know, it always crosses beneath it. But once again, look at this price action over here. Look at this. All right, I want you to see this in particular right here. Do you see how right over here we have lower lows across the board consistently? Lower lows, lower lows, lower lows. It's getting lower. But why is the stochastic going up like this? Look at that. Lower, 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 higher, higher, higher. Again, you can be more accurate if you really wanted to, right? Right. But that, to me, is a clear lower low, lower low, lower low. Higher low, higher low, higher low. That, to me, off the bat, shows a possible bullish divergence, right? Now, again, if we have this price action, this candle drops down dramatically, and then this comes down here, sure, it kind of negates this, but once again, we can see clearly lower lows, lower lows, lower lows, higher lows, higher lows, higher lows. Eventually, we should see a break and a bullish breakout from RL, right? That's what we're looking for, truly. Let's check a few more. So UMPQ, again, this is a harder one to spot, but again, with a good eye when you get better at it. Again, -40, every time it gets below it, like with the RSI with 30, you would have made money almost every single time. But once again, why from here on the stochastic and over, we see consistent lower lows, consistently. But this whole time from about, here over, this trend, we've had almost clear higher lows. Once again, that is a sign of a bullish divergence. We can see clearly every single time. We have a lower low over here. Oh, okay, lower low, but that's higher. So again, we had a nice move of almost 7%. Oh, we have another almost equally lower low. Oh, well, that's a nice move of 13%. Oh, it gets down here again, right? Oh, it's much higher on the price action than over here. That's a bullish divergence, right? Just like this. It's a bullish divergence. Okay, well, we had a nice little easy 5%. Oh, we're down here again. Another, that one checks out, but overall, okay, well, another move up. So all we're looking for with Stochastic is, again, negative 40 is a great place to buy into, but once again, a bullish divergence is clear to see. Let's check one more. This is IRWD. It's a fantastic ticker to be watching. I do enjoy watching this one. Let's do this real quick. We have a clear bottom, right? This thing bounces the bottoms right here consistently. But why? Every time we come from over in this area, right, we have higher lows across the board. But we have a very strict bottom here, right? That is also a divergence. When you have one that's flat and one that's an angle, whatever it may be, or I mean flat, and this one has angles, whatever it may be, that's also a divergence. If it's not perfectly in tune, it is a divergence. Again, it's only one more thing to add to it, but when there's not perfect levels of it going up and up or down and down, they are a bullish divergence. You may be thinking, this is complicated. Yes, if you're new to this, it can be very complicated. So again, do not get discouraged. It's just important to understand when you have a bullish uptrend on the bottoms for the price action, but then bearish lower lows on the stochastic, it's a clear bullish divergence. That vice versa, this and that, this, that, whatever it may be. If the bottoms don't match up, bullish divergence. But once again, what can help you from hurting yourself are bearish divergences. Look for those as well, and I'll show you. So this is LAZ. I'm watching for an entry. Again, it's probably broken down, so we're gonna clear that. That's a big sad moment. But once again, let's look at this. What could have helped us to see this coming? Look at this. Oh, okay. Higher high, higher high, higher high. But on the stochastic, almost perfectly, we have lower high, lower high, lower high. What happened? Kerthunk. They came down super hard. So you may be looking for bullish entries, but again, you should always be checking for bearish ones as well to stop yourself from getting hurt. Look at that. If you would have seen this happening, lower highs, higher lows, you would have known right here could have been a good shorting opportunity possibly, but more importantly, you're most likely coming down hard and fast. Now again, we're at negative 40 down here. Probably find entry for a support play. Again, it's a great support area, but once again, finding bearish divergences is also a great idea. Let's look at one more. This is MTG. We can see of clear note a triple top on the stochastic right there. 1, 2, 3. But on the price action, higher high, higher high, higher high. Again, straight line, higher highs, higher high. What happens? Plunk, it goes off the edge. So once again, you may not want to look for or trade off of bearish divergences. When the tops don't add up, you're like, well, I don't care. You should care. Because if the tops do not add up or match up, you have a possible big sell-off coming. Make sure you're very careful about that. So you may be like, yeah, RSI makes sense, stochastic I'm still kind of weak on. That's fine. Take your time. Again, this is supposed to be your edge and what you're supposed to be using. I don't think stochastic divergences is really something you need to be using as a beginner, but it will give you some really great insight, because when you have lower lows on the stochastic, but higher lows on the price action, that you should chime off saying bullish divergence, a big move up is coming. And again, when the tops don't add up, you should be thinking this stock has a higher chance of collapsing on me, so I should be very careful. RSI, super simple to use. It's great at alerts. It's fantastic. It's great for momentum. I like it a lot. So the last two is volume and volatility. Now, volume and volatility are pretty great. Volume is really quick, and I'll show you, but the major index is what I use mostly for volume. Now, when it comes to equities and stocks, I don't really trade stocks below 300,000 daily volume just because it's my benchmark usually. Anything below that, you have a hard time getting out. Remember, if you want to sell a stock, somebody has to buy it. If there's no volume at all, you getting out of your position where you want to is probably a lot less likely. So if you have like 40,000 daily volume and it's selling off hard and no one's buying, you're stuck. It doesn't matter if you want to get out or not. So again, the more volume, the easier, more liquid it's going to be. You can get in and get out. You can get out in and out of Tesla and Apple 2 seconds, right? You have a small cap biotech, it could be 2 or 3 hours. So make sure the volume is correct. What you're gonna notice most times with volume is, again, we talked about this, is the size of the candle is what matters. And so I'll show you the major indexes. There's one thing I follow with major indexes in many stocks, and it's this. We usually take the stairs up and the elevators down. You're gonna see small volume, like 1/5 or 1/6 the size of the big ones, on the way up. Boop, 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 boop. People taking the stairs up. Stair up, stair up, stair up, stair up. Just taking their time. But when it comes time to sell, boy, it's a hell of an elevator. You're gonna come down super hard when it's a high volume stick usually, and I'm gonna show you. So this is the SPY, or the S&P Spider Index. So this tracks the top 500 companies. What I wanna do is I'm gonna show you every time we break above, let's just say this area for volume. Every single time I break above this line is probably a high volume day. So let's kind of zoom in a little bit, right? We can come back a little bit. Every single time we break above it, we can see red candle, red candle. Oh, a green boy, that's interesting. Oh, red, red. That one's green, interesting. Even that one, red, red. So off the bat, you know that with the S&P in this market is obviously bullish, as we can see. Right, it's going up. Most times we're going to see small volume as the green candles and the large candles are red. What we're looking for are stairs up and elevators down. Like this. Oh, stairs up, boop, 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 taking our time, big red down. Oh, stairs up, boop, 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 taking our time, big red down. Again, stairs up, oh, da, 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 da. This is a rare meltdown, right? But again, stairs up, blah, 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 big red down. So you're going to notice on many time frames in bullish stocks, volume is important because we have a lot of bulls coming in slowly, like 200,000, 200,000, 200,000, 200,000, 200,000. And then the last day of that red one, 1 million come in because we're taking the stairs up and elevators down. So one thing that this is important with is you're planning on the macro indexes and your tickers. You can see clear times here. Stairs up, blah, 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 big on elevator down, stairs up, elevator down, stairs up, elevator down. So you can see clearly by looking at the S&P, for example, much smaller volume. Look at this, much smaller volume this whole entire time. See, there's very little volume in this area, very little, right? We have one day, which is again red, ironically. A lot of small green boys, a lot of small green boys, a lot of small green boys, peaked by a red, again, peaked by a red, and then over here, when we get to this massive volume node, look at this. This massive volume area. Main color, again, is red. So again, when you have a lot of green coming in, when you see a high volume spike and it ends up red, might want to get out. Again, it's an elevator down. Let's check another index. So this is the NASDAQ. It's the spider that I follow. I enjoy it a lot. Once again, we can see clearly the highest volume nodes right there. That bad boy right there is red. This bad boy right there is red. This one over here is red, red, red. We can see a bunch of times this whole area, once again, this whole area, this is low volume. It's very low volume, right? The only time we have high volume is here, which again is red. Again, high volume, red. Low greens, high volume, red. On many stocks that are bullish on the way up, you'll have low volume on the way up and high volume on the way down, and it's red. So again, I use volume for my equities as signals. Stairs up, elevators down. When I see a high volume day, if it's already pretty up there, pretty high up on the channel up or the trend up, whatever it is, more likely than not, that bad boy is coming down. That's about it when it comes to volume. You may be like, I wish there was more. I don't use it for much more than that. Again, volume profile sheds all the volume I need to know about where supply zones are. But again, when it comes to volume, especially for the macro indexes, but many times on the way up, you'll have nice little, nice chill buy and bull days. When that big red spike comes in, elevator down. Stairs up, elevator down. The last thing that we look at is Vortex. Now the Vortex indicator actually started in 2011. It's what I use for volatility. It's also great in use with the RSI and the Stochastic for value, but again, it has a MACD feel to it if you want to try the MACD indicator, but I love using it because it gives us a much better insight. I'm going to show you. So this is ATI. It's a really nice uptrend. It's looking good. Recently, it broke down. That's been the whole signal of today, which is ironic for the day I'm filming. Let's do this. Studies, edit studies, Vortex indicator. Beautiful. Off the bat, you're like, what the hell is this? So it's going to show you the volatility and then the bullish and bearish momentum. So I put those together in the Vortex indicator. There's multiple ways to use it. This is how I use it and how I show great volatility. So I'm gonna again use my time signal here, my time level. I want to buy every single time the green line is low. That means bulls are low. Bulls are oversold, they're low. I love it. So we have great volatility off the bat. I'm checking to see we have clear levels. Look at this, it's going up and down, super easy to read. Every single time I see the bulls this low. All right, once, twice, 3, 4, 5, this low, it's a great sign of value. Every time I see the bulls up above this area, I should be primed to sell, correct? So let's use this. Let's use our time level. We're gonna make it green for an entry, all right? Green for an entry. Right here I would have entered. Right here I would have entered. Here I would have entered. Here. Here. And here. Those are my entries for the Vortex indicator. Every time bulls are low, I would have wanted to enter. Let's use the same exact level, okay? Let's make it red for where I would have exited, given that the bullish momentum hit the top. I would have exited here. I would have exited here, 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 and as of recently, here. So once again, with just using the Vortex with the green line, every time the green line went from the bottom to the top. Now again, this would have been the same move. So let's go from here. I would have made 41%. I would have made 3. That didn't work out. Here I would have made about 24%. I would have made about 24%. And once again, a nice 10% move. You can see it's very similar to RSI, but it's much more momentum based. It's much more volatility based. You can enter clearly off of when the green hits the bottom, but you can also use it for different things like this. So using the same idea, most folks use the Vortex as a crossover method like I mentioned. You can enter based off of a crossover of a EMA line, but again, the Vortex crosses also works for a sign of confirmation. Some folks wait for it, I don't. I wait for value, and then if it crosses over in the Vortex, I know I've confirmed I made a good choice. We can see clearly every time green crosses over the red. Let's put a mark there. Green right there, green crosses the red. Green right here crosses the red. Green right here crosses the red. Let's see, green right here crosses red. Go through it. This is really convoluted. We're going to avoid this area. Green crosses the red. Let's see, green crosses the red. Green crosses over the red. Every single time we see it, let's mark it. Every single time. Coming through. A very convoluted area, but right there as well. And right. That's a little bit convoluted. So let's go through. Every single time the green crosses the red. Made money. Made money. Again, this is a fake out area for sure. We made money. So you can see every single time it crosses over, besides here, we got faked out. Boom, big fake out. But green crosses, fake out, fake out. So we can see more times than not when green at the bottom crosses over that red, so green comes up, red comes down, it crosses, you have a great sign of confirmation. A lot of folks use Vortex for crossovers as well. I like that a lot. Let's check the next one. So this is CCJ. Once again, we can do the same exact thing. You can enter off of Vortex value. I would consider that probably around 67, all right, 68, 67. And then you can also go in when the green is this high, right? So once again, we can come back through every time green gets that low. There, this area, go through every single one. Good stretch. Right, every single time the green gets low. Money, money. A little bit of a fake out, but again, you could have bought in anywhere in here and held and made money. Money, money. Again, a bit of a fake out, or you wouldn't have held this much probably, but again, made money and made money. So again, when the green is that low, you have a high chance of making money and doing a good job. Isn't that right, Gremlin? You have a good chance of making money. I like that a lot. Let's check the crossovers. So every time the green crosses over the red, right there, right there. See, there's a lot of them on this one. It takes intense concentration as my cat licks my hand. Thank you, young man. I'll reward you with pets later. I'm not filming in class. So you can see plenty of times the green has bullishly crossed the red. It takes a minute to go through all of them, but again, that's really important. So once again, the green crossed the red, money, 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 good, 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 good. The problem is, if you would have waited for the crossover, you probably would have missed a lot of these, or been really close to missing some of these. So again, I buy off of value, but just looking at this chart, if I was said I bought it every time the purple line, you would have had a really good time with CCJ. Again, CCJ is a great setup. I mean, chart-wise, you can even see from the moon, this is a beautiful uptrend that I'm currently watching, right? This is a great spot here, come over, yeah, breaks a little bit, but this is always coming into a great area of support. Obviously, we have our, our support area right about here. It's coming where I want it. The Vortex was low. You could have bought here. Again, you could have bought where it's low, made a quick 7%. Again, CCJ, price action-wise, makes a lot of sense, but barring that, the Vortex is showing us some great things. You can also buy when the red line is overbought with the same exact idea, because you're going to see many times when the green is low, the red's also high. So when I see that like over here, see how high up the bears are? Bears are overbought, bulls are oversold. So again, that's a great sign right there. So you can follow the green line, you can follow the red line, both work just fine. Vortex is great for volatility because it shows you really big gaps and shows you everything you want to see. It's like RSI mixed in with Stochastic, mixed in with everything. It's a fantastic indicator to show you bullish value and bears being overbought. Let's check one more. So this is NXE, ironically also a uranium stock like the last one. I like uranium right now. Again, June 2021. If you're in my Discord, buy uranium. So this is a really good looking area to buy into. Again, price action makes complete sense. Again, a very obvious uptrend. It's glorious. I love it. So going once again, we want to probably buy whenever this stock gets to about 67, 70. We want to sell when we get to about 1.22. Again, for a full move. So let's put every time it gets to the bottom. There. Every single time it taps the bottom. Because again, we gotta be fair. You can't just be like, well, I'm gonna cut some of these out. Nope, it has to be every single time. So we can see every single time. Money, money, fake out. Again, which would have again eventually held and made a bunch of money. Great move, fake out. Again, this was again a nice fake out, wouldn't have worked, would have made money, money, money. And again, you weren't pairs with a trend line, like a properly drawn trend line like this, you would have seen, the buying here was not very logical, obviously. You would probably want to bought closer to this area. But again, that's the shortcoming of using an indicator, and that's it. So again, you could buy when the green is low, and you could sell when the green gets high. So this works great. And again, just to show you with the red line, you can buy when the bears are overbought, and works just fine as well. And I'll show you. So once again, the same exact idea in mind. Let's draw a line every single time the red hits the top. So red there hits the top. Very close. Red hits the top, red hits the top, red's the top, red's towards the top, hits the top. We'll see. So every time the red hits the top, money, 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 money. Again, that fake out area, money. So again, the green line being low and red line being high are almost the exact same thing, but again, you can use either one for a great entry. And once again, you can hold every single one for a crossover you wanted to. Crossover here would have made money. Crossover here would have made short-term money. Crossover here, right there, would have made money. So you can see the Vortex is a great indicator for showing you some forms of confirmation and value. Again, some stocks may not be as volatile, and this gives you a nice clear lens into that volatility. It works really well for me. Vortex is one of my favorite. You buy low, you sell high. It helps you hold. It helps give you some clarity. It's a great indicator. I like it a lot. The last thing that I use is the VIX. Let me show you. So this is the VIX, VIX. It's the Market Volatility Index. What you want to see with the VIX is red. This is a fairly rare occurrence where red is good. When the VIX is going green and really popping off, that means people are afraid and stocks are volatile. When the VIX is going red and dropping down, that means most indexes are going to be green and folks have less fear. So this is a rarity where I want to see a lot of red and not a lot of green. One thing to mention with the VIX is that it is a decaying and ever-changing indicator. It follows supports, it follows trends, but even on the 10-year, you can see clearly that this thing, again, is always kind of coming down, and they reset it and it goes back up. You can always use fairly good option calls and option puts on this for some great stuff. But you can see clearly these spikes, and again, every time we see a spike like this area there, that area there, all these spikes were probably parting up really highly with red days. So any of these really big spikes is most likely when there's a lot of red. And a lot of these bottoms down here, these rundowns, is when we saw really big green runs. So mainly over time, we want to see the VIX being low. If when it gets high, we want to get kind of nervous to buy in. So more times than not, whenever we see these big spikes like this, that was a really nice big move up. That's probably a red day. One thing I always watch is this. I like to take my big peak areas, come over with my trend line. This actually works fairly well. I wait for the next peak, and I like to draw some trend lines like this. Right, I like to do things like this and watch them, like peak, peak, peak. And then we saw, boom, a big move up. Once again, we come to this peak and come over like this, into this area like that. Peak, 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 boom, big move up. And now I'm tracking this. I'm trying to see what kind of peaks I can get out of this. One thing I do is that I like to follow the big moves. Then you can see they line up. If they do line up like these do, more likely when you get a breakout, you'll have your next big red day coming up. It's a little bit hard to track, but again, it does work out fairly well. You can see overall though, this is a downward channel, just like how the S&P 500 is an upward channel. So again, we have a nice differential where this is the opposite of what we're seeing. Again, VIX going down is a good thing. What I use the VIX for. On red days, I don't like to enter too quickly, but once again, red means there's good deals. You have to have red days to enter. So what I like to do with the VIX is this. I'm gonna watch for supports and resistances. Again, I'm gonna go to probably the 10-year chart to get the full scope of it, but right here, this area is a support, that's a support, this is a support. Again, coming through, making some lines, just like that. All right, now we zoom in. Every single, and you can see how many channels we made just from that, right? Big moves. I'll probably put one right here. That's good, right? So every single time we see the moves come down, we're more likely to have a red day towards supports. One more time, we're more likely to have red days when we hit supports because we just came down. So I look to buy towards resistances. So we can see clearly whenever we had a big move like this, a big move up here to about 1975 or 20, we had about a 1 to 2, 6, 7, 8, big move down. We had nice days to buy in towards the resistance and then ride this green wave to support. Again, if you would have bought in up here, you would have had about a good 4 or 5 days of green. Again, we had a huge spike up. We saw it coming down. Buying from that big run up, you would have had about 12 days of great green run up. Again, you hit this resistance, it comes down. We had a 5 or 6 days run. So once again, I don't rush into stocks, but when we have a really big spike on the VIX, let it run. That's gonna show you some massive volatility in the market. Let it show its big red hand. But once the S&P hits supports with the VIX, you can look to buy in. So we have these big spikes. This happened on 5/12, as we can see. 5/12, that big spike happened. Let's go to SPY actually. 5/12, we can see that was actually right here. Let's delete these real quick. So 5/12 on this time frame, we can see right here. 5/12, the opposite, right? This big spike on VIX was right here. Big spike, right? And this whole entire time it's been running down on the SPY from 5/12, which again is right there, right? This whole run up, you would have captured by letting the VIX run up, let it run up, show volatility, come down and say, all right, we're going to see some green. We're going to buy in because there's less volatility. Even here at 5/18, let's go back. At 5/18, right, we would have seen right here, another red day, VIX hits the top, you would have caught this whole entire move, right? Because you would have seen the VIX came back up, made a big spike up, it came back down and kept showing red, 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 red. You ride it all the way down and had a good time. So while most people are being fearful, you should be confident. When folks get overly confident, you should get fearful. That's what they're saying. Whenever the VIX is at support or super low, get a bit nervous. You're probably going to see some volatility coming because once again, folks are taking profits, right? If folks are printing that money, they got to get that money and guarantee it. They're going to sell, which leads to volatility. When everyone's selling and their prices are dropping, the VIX is going up, you should be looking to buy in, or at least having the foresight to watch the S&P, the NASDAQ, the Dow drop into supports and buy in there. So just review with the VIX again. When it's spiking, give it a day, give it some time. But again, when the VIX is spiking hard, that means volatility is increasing and folks are selling. When I see the VIX spiking, I'm going to the S&P, the NASDAQ, the Russell 2000, and the Dow 30, finding supports. When those VIX spikes go up and the S&P and the NASDAQ come down and hit supports, that's where I'm buying. I'm buying low and selling high. So it's more of an art form using the VIX to show volatility, but when you use it correctly, you can be 2-3 steps ahead. Everyone else is playing chess and checkers. You are playing 4D chess, right? Stay ahead, buy low, sell high. And there you guys have it. That's how I use my indicators. EMA lines show the trend. Your RSI and your Stochastic show momentum. Volume profile and traditional volume show volume. And then the VIX and my Vortex show volatility. Those are the 4 things an indicator should be used for. If anyone else is using them for anything else, it probably works okay, but again, beyond that, not the greatest use of them. I need to reiterate before I leave you for the day, price action always comes before indicators. Yes, you can scan with a 200 cross or like a VWAP cross or a CCI value, whatever you like, it's totally fine. But price action always comes first. Your indicators show trend, momentum, volume, and volatility. Those 4 things should reinforce or deter you from entering positions that you based off of price action. Indicators, of course, are technical analysis, but again, they should just further reinforce your risk management, your technical, fundamental, and mental analysis, your macro trends, your trading plan, your goal setting, and lastly, your consistency. Indicators lead to technical analysis, which leads to these things being reinforced. That's a good thing when used correctly. When you use EMA lines for trend, it shows you great supports and resistances. It also shows you the trend of the stock. It can be used greatly to show you a great value. Like when you cross below the 200 EMA line, you have obvious value. But again, those EMA lines will be resistances when above and supports when below you. So again, keep that in mind. They're great, but again, they're used for trends and bounces. The RSI and the Stochastic indicator is what I use for momentum. It shows great value and it shows you divergences. It again gives you a good leg up above everyone else. It shows you when the price action is correct, and again, when you have RSI low and price action at value, and the EMA lines show it when those are stacked together, again, it can show you great value for a play and great value for an entry. We covered volume profile before, I'm not going to cover it here, but again, traditional volume, what I use it for, again, it must be over 300,000 shares a day traded. If not, you're not going to get out of your position quickly. It's not liquid enough. I don't like it. But 2, more times than not on your large cap stocks and your really defined blue chips or indexes, you're going to have stairs up and elevators down. Boop, 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 crash. Da, 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 crash. Right, you always have stairs up and elevators down. The large volume days, when you see massive volume spikes, 9 out of 10 times in a bullish market, for those really defined blue chip stocks, they're going to be red days, good days to get out, / the best days to buy in low. Lastly, with volatility, we show you the Vortex. Again, it really separates bullish and bearish momentum and volatility. You want to buy when green is low, and when it crosses over from green to red being higher, that's your confirmation you did the right decision. Hold until the top if you want to. Buying low, selling higher with the Vortex is much easier than a lot of things. And then lastly, the VIX. When the VIX spikes hard, again, you should take your mindset for being like, oh God, what do I do? Think. When the VIX spikes and days are selling off, what you're doing is going to the -ES or the S&P, -NQ or the NASDAQ, -RTY or the Russell 2000, or -YM or the Dow 30. You're waiting to find supports on a trend line or a support line. Watch it hit that area and hold. That's where you're going to be buying in. Again, you buy low and you sell high. You need red days. The minute your mental analysis goes from, oh, red days suck, to red days is when Papa or Mama is scanning for great plays and I'm buying in there, that's when you become a really good trader, right? Some folks get scared, you buy in. Some folks get overconfident, you get scared and start locking in profits. You must stay 1 or 2 moves ahead. We'll get a mental analysis later, but again, the VIX shows that. I hope you enjoyed this lesson. Next up is talking about loading zones. I'm going to show you how I cut out the nonsense and just draw on my actual charts a box to show you where my loading zone is. After that is price targets, stop losses, convergence in my system of buying in, writing an actual trading plan, then what you do when you buy a loser or a winner. And then we're going to validate all that with selling out. Coming up soon, lesson 21, how to draw a loading zone. Let's get it.